Okay, we still can't see the attendees, unfortunately. Okay, there they are. All right, so we have a good crowd today. Thank you so much for joining us. Please let me know if you can see my screen right now and if you can hear me. Please type in a Y for yes if you indeed can hear me right now, so that we make sure that we don't have any technical issues over here. Okay, so today's webinar, as we had said before, and you probably saw in the Orbex flyers, we're going to cover the economic data and the views. Okay, thank you. Thank you very much for writing. Okay, so apparently the speakers are working, unlike last time. All right, so we are going to cover the economic data, global economic data that affect the major currencies, major and minor, and basically give you a brief on what is going on in the world and what you should be looking out for if you are an avid Forex trader. We are going to start today with an introduction of Orbex and Investiva, and then we're going to jump in to major economies. We're going to start off with the US, then go on into the Eurozone, UK, Canada, Australia, Switzerland, and Japan. So without further ado, please get prepared, grab a pen and paper so that you can take notes if you hear something that you like and you would like to remind yourself later when you're actually trading. If you are not familiar with Orbex's Traders Library, definitely do go to orbex.com and check out their videos and all the other Forex trading information that they publish on a daily basis. My name is Kiana Daniel. I'm your host today. I'm the CEO and founder of Investiva.com. I'm the author of the Forex trading book published by McGraw-Hill. His name is Investiva's Guide to Making Money in Forex. And if you are a beginner or you would like to brush up in your trading skills, including technical analysis, fundamentals, market sentiment, capital analysis, and risk management and so forth, definitely is a recommended book for all of you. So without further ado, first of all, let's see who in the audience have been following the FOMC statement and the rate decisions. Let me actually tell you that this is a live webinar. I would greatly appreciate your interaction throughout the webinar. So as you might have known, we had a much awaited FOMC statement last week, and I would like to break it down to those of you who are not basically, I don't know, paying attention to what's going on, and tell you what happened and what things you should know about this statement and what we could expect coming up, and what this could affect the US dollar's Forex price action. And there is a spoiler alert, if you already don't know, the dollar bulls were not so impressed with the results of the FOMC. So the most highly anticipated question is that will the Fed hike the interest rates in September or anytime? What's going to happen? So there are a lot of people who are impatient about this, and there's a lot of argument going on about this. But this is probably how most forex market watchers have been feeling for quite some time. And the June FOMC statement actually failed to provide any strong hints on when monetary policy tightening might take place exactly. And I mean, if you have been following Janet Yellen, the Fed head chairwoman, you probably already know that she likes to play with everybody's feelings all the time, and that is what she's been doing. She keeps us on our toes and doesn't ever give us an exact statement as to what is going on. In her press statement, she said that no decisions has been made on the actual timing of the liftoff, which is the term FOMC members are using to mark the start of their rate hike tightening cycle. So Janet Yellen actually even tried to downplay the importance of the first Fed rate hike, and she said that their policy is what is truly matters, whatever that means. So with that in mind, the FOMC basically unveiled their projections, and it basically gave us no clue at all as to what we should be expecting over the next few years. So there is more exciting topics coming up about the Fed rate. I'm right now only covering what the FOMC said and how you can actually, just by listening to FOMC, analyze it. So the economic experts actually say that what FOMC has been implying is that there are not only one but two interest rate hikes coming up this year, because, so this is like basically regardless of whatever Janet Yellen said, the reason why for this analysis and this projection is that the policymakers projected that the benchmark rate might eventually move past 0.5% from its current levels of 0 to 0.25%, and so that is the reason why they're thinking that to keep everything in balance, we may actually see two rate hikes, right? So now you probably are asking, like, does economic statements support two rate hikes for these analysts who are saying this? And actually, it's not only the analysts. Powell, from a member from Federal Reserve, was the one saying this on Tuesday, which did bring about huge U.S. dollar strength. If you were following my Investiva updates, you probably know about this. So why did Powell say this? Does the economic statements, that the economic data support this? So let's actually go back a little bit. The Fed decided to lower their GDP estimates for the current year, for 2015, so that they can take the Q1, quarter one slowdown into account. They also adjusted their 2015 unemployment rate forecasts, and they actually brought it a little bit higher. So it used to be 5%, and then it went up to 5.2% estimate in March, and this time they brought it even higher up to 5.3%. So the inflation estimates, other than unemployment forecast, inflation estimates, which is a key factor in rate hike decisions for this year, were actually unchanged because the Fed officials are still counting on the effects of the oil price going down and they're hoping that it keeps fading. The Fed members are more optimistic about an economic recovery for 2016 and 2017. So we know that because they upgraded their growth and inflation forecasts for those years even more than 2015. And Janet Yellen has emphasized that any policy changes could continue to be a data-dependent factor, and that implies that any sign of a strong pickup in the next few months could fuel the speculation of an interest rate. So stay tuned, and if you see a more good data coming out of the U.S. that can back up a possibility of a rate hike or even 2 rate hikes this year. So now let's talk about inflation and the U.S. dollar strength. Does this back up the 2 rate hike estimate? And what did the FOMC statement have to say about it? So the fact is that the FOMC statement in June didn't actually seem to dwell too much on the downturn in price levels, and that suggests that the policymakers are not really anymore concerned about the weak inflation that we've been seeing. They used to be more concerned about it in their previous announcements, but they are not as much anymore. Janet Yellen did acknowledge that the drop in energy prices has been mostly concentrated towards the end of 2014 and early this year, and that says that the price level seem to have stabilized so far, and we in fact have seen the stabilization of the oil prices in the past few weeks. So reporters did ask Janet Yellen about the U.S. dollar's impact on overall inflation, and she admitted that it is still a factor affecting their outlook among many others. While she was obviously still playing hard to get with any direct answers, but she did say that, and I'm quoting here, that in spite of the appreciation of the dollar, the committee obviously thinks that the economy is likely to do well enough to likely call for some tightening later this year. So an inflation tightening would again end up to a rate hike. Janet Yellen also said that they are counting on improvements in the labor market and wage growth to keep the growth in inflation supported. And with that, forex traders like you and I, if you are a trader, could pay close attention to jobs data. These are the things that you want to take notes of. So these are the things that in the coming months you want to keep an eye on. Jobs data, I'm going to repeat, earning figures, and I think basically that's it to judge if the U.S. Central Bank will stay on track to announcing a rate hike soon. So that's about it about the U.S. dollar. So what do you think, guys? Do you think that the Fed will go ahead and hike the rates this September, or you think that the economy isn't that strong yet and they probably will wait until next year? Do you think that September is too early and they might have to wait at least until October or December? Or you think that Janet Yellen is just being a coy, but it's about time that they rake hikes as soon as possible? So if you have any opinion about this, do type it here in the chat box so we can hear from you guys as well. So just to cover it up, a U.S. Interest rate hike will in fact lead to a U.S. dollar strength. I would actually like to take a moment and show you the U.S. dollar charts to see what we could expect, technically speaking, from the US dollar. Hold on one second. I would like to bring up my charts. So the chart that I would like to show you right now is actually that of the dollar yen, and the reason for that is that the Japanese yen, we are going to cover the Japanese economy, but the reason for that is that the Japanese yen has been kind of consolidating, and it has been following the U.S. economy trends in its movement, so we can do a technical analysis. So technically speaking, as you can see in the chart over here, we have broken above the Ichimoku cloud and a very key resistance level, which is now a support level of 121.50. And right now, the pair, well, we did have a pullback after our breakout. And the pullback is obviously natural in these cases, and now we're facing a consolidation followed by a bullish, semi-bullish sentiment. The RSI is hitting up, the Ichimoku cloud and its other moving averages are almost all moving up, well, besides the Tenkan line. Oh, I'm sorry, this is the Kijun line. Besides the Tenkan line, which is flattening, which shows some recent indecisiveness, but there is no indication of a drop. And I would like to actually zoom out and go back to the monthly chart to see how high can the US dollar go against the Japanese. And as you can see right now, we are just testing the highs of 2007. The market, the US dollar, has never been this high in over 8 years. But just when you think that can we go even higher, the answer is yes. Right now we haven't been able to break above this level of 123. So we have broken above, we have tested above it, we haven't precisely broken above it, especially on a monthly perspective on the technical chart. But if we do break above it, then we could see even more rallies towards the highs of 2002, and that is 134, 135. That means if you are planning to go to Japan, that is going to be very expensive for you if that does happen. All right, so please do type over here if you have any questions. Next, I would like to cover Europe. I'm going to share my screen with you in a minute when I bring it up. I have a chaotic screen right now. So you probably have already heard a lot about Greece and their problems and everything that is concerning people. And in my today's updated Investiva, I actually did cover, does Greece even matter to the currency of the Eurozone, to the single currency, to which is, well, basically the euro. So let's start with what is going on, what are the latest on Greece. So the latest that was actually updated an hour ago is that the people are basically, the creditors, international creditors, are doubtful that a deal will be reached with Greece, with Greece's government, and international creditors actually rejected the Greek government's plan to end its financial crisis, but they have submitted counter proposals, which means we are still going to be hearing about Greece. It is kind of a never-ending loop. So obviously, again, this news you hear on the headlines, it dashed hopes of an imminent deal between the between Greece and the other powerful nations in Euroland. What is going on in Greece is that they need additional financial aid to prevent Greece's economy from defaulting on its 1.6 billion euro debt at the end of this month, but the lenders have refused to release funds without the implementation of more reforms. European officials set a Thursday deadline, which is basically tomorrow, so Greece's parliament has time to pass any required reforms before the repayment is due. So that is the latest about Greece. I would actually, let's see if I want to even, yeah, let's just cover Greece a little bit more, and then we're gonna jump into the economic data from the rest of the Eurozone. I would actually like to pull up the my trading chart to show you how Greece's movements and the troubles and the headlines have been affecting the European currency every time the headlines are out, so you can make a decision on your own if you would like to follow Greek news when trading Forex. So this is an instance of euro dollar on a daily chart. I don't even want to go further back due to my short-term memory. I just want to take a look at the markets today. So, for example, yesterday, we actually heard not so bad news from euro, and at the time, the Greek troubles seemed to be ending Tuesday, and the headlines were generally confident of a deal being done, and everybody was happy, despite the risk that the Greek parliament might not approve their own bailout terms. And despite of that, in the hopeful headlines, we saw a massive euro drop. So basically, the Forex traders completely ignored the headlines out of Greece, and actually they paid attention to other data out of Europe, which was actually the IFO German survey. It's a survey that out of Germany that basically anticipates the climate and the strength of the Eurozone as a whole on a monthly basis. And so what happened is that the IFO Business Climate Index fell to 107.4 from 108.5, which was the previous month's index. So this basically, for example, yesterday and today, yesterday was an instance of the markets not the Forex market not paying attention to Greek headline. How about today? Today, right now, you can see this green candlestick right over here. I just read you the dismal news out of Greece that the deal wasn't done, and look what happened. The euro actually has been inching higher up, which again shows that the headlines of the markets, the Forex market, doesn't really directly pay attention to the headlines out of Greece. Again, this is a personal opinion, observation. If something dramatic happens in Greece, we could see a Forex market reaction to it, but in the past few weeks, that hasn't been the case. But now you may ask, does Greece have absolutely no relation to the Eurozone economy? Well, the answer is no, because, well, again, I'm going to go back to the IFO business survey that showed that the level of a composite index, which surveys manufacturers, builders, wholesalers, and retailers all over Europe suggests that the ongoing Greece troubles are in fact having an effect on the Eurozone as a whole. So that data came out, and that did affect the market, and yesterday we saw the drop. So my recommendation for you from now on, if you are a Euro trader, is to pay less attention to the noise that you may be hearing over and over again all the time in your news feed, on TV. Pay less attention to Greece when trading Forex, and pay more attention to the economic data that comes out from the central banks of European countries. I'm going to switch back to my PowerPoint. So next we wanted to basically cover up. I think actually we are kind of done with Europe, because all we hear about Europe is Greece right now, and other fundamentals are not being coming out this week. This week's fundamentals has mainly been focused on the U.S. Next, we are running out of time. We have only half an hour. I do want to cover the UK economy and what you must know about British pound and what you could expect from the UK economy. So as you may have noticed, the British pound has been getting higher despite its natural correlation with the euro. So whenever the euro, normally euro and the British pound are correlated, which means they move parallelly. So if the euro goes down, the British pound goes down, but that has not exactly been the case in the past weeks or months even. So here's a rundown. I'm going to cover the inflation, the wage growth, an expected rate hike, and then walk you through the chart of the British pound to basically cover everything up. So if you have been following the UK market catalyst scheduled last week and the British pound's Forex reaction to those reports, then you'd probably know that the currency was off to a running start as soon as the CPI figures were printed. Even though the actual results didn't exactly beat expectations, the British pound bulls, who were still pleased with the latest reading from last week. You see, it's not enough to just look at whether the actual figure came in above or below the expectations. It's also important to check how it compares to ongoing data trends. Headline CPI logged in an annualized 0.1%. It was an uptick, and it came in as expected, and it was an improvement over April's 0.1% decline in price levels, and enough to show that the economy made it out of its brief encounter with deflation. The core CPI climbed from 0.8% to 0.9% in May. This also clocked in a small pickup for that month, and it marked the end of a 4-month tumble in core inflation from its 1.4% reading that we saw all the way back in the beginning of the year in January. Another thing that has been backing up the British pound rally's recent up moves has been the pickup in wage growth. And basically what's keeping pound traders hopeful is that the UK can avoid another brush with deflation, is that the strong increase in wage growth recorded in April. that is one of the major backup for British pound bulls. The 3-month rolling average came in at 2.7%, which was higher than the expected 2.5% increase, while the March reading was revised again up from 1.9% to 2.3%. So again, if you have been tuning into the Bank of England's monetary policy statements over the past months, you'd know that the weak wage growth has been one of their biggest concerns, and the policymakers had been watching to see an increase in wages so that the Brits will be in the mood to ramp up their purchases and businesses, other businesses will have a good reason to increase their prices, right? So that basically means hitting two birds with one stone when it comes to boosting consumer spending and lifting inflation. So that is also all good. So now that the economy, the UK economy has gone up, has ticked up a little bit to a healthy economy again in wages and in healthy gain in wages and inflation, Bank of England officials might actually be much more confident about their inflation outlook. While the latest Bank of England minutes indicated that a Fed interest rate hike might bring risks to global economic prospects, the MPC members emphasized that their decision to tighten would be mostly based on UK inflation trends. For now, Bank of England policymakers were still on anonymous, and they were basically not giving clear hints, and they're still kind of vague about it in their vote to keep interest rates and asset purchases unchanged. But hawkish members, namely, let me remember the name, I think it's pronounced McCafferty and Wheel, they said that their decision was finally balanced, which is basically the Bank of England speak for so close to voting for a rate hike, but not quite. McCafferty, before in an earlier speech, had already mentioned that the time for raising rates was getting closer and that upcoming data would determine when tightening might take place. So just like the US, the UK is also waiting for more positive data to make a decision on their rate hikes. Let's actually go ahead and take a look at the British pound chart. I'm going to take a look at it versus the US dollar because we just covered that. So you can see that the British pound was in fact going up. We are facing a pullback right now. But guess how far it rallied to? It rallied all the way to 50% Fibonacci level, and that is a major resistance level, technically speaking. Well, yesterday, today, and basically this week, we have been seeing the pullback, but this doesn't mean that the rally is over. The market is still, the pair is still above the Ichimoku cloud. We have broken above the 38% Fibonacci retracement level, and we could see a recovery, especially if the US dollar, well, this one, because we've been having a very strong US dollar, let's actually take a look at a different British pound chart to get a better idea about how it's been going and moving in the market. So comparing to Swiss franc, as you can see, it has been definitely going up with no pullbacks. That's the reason why I'm comparing it to Swiss franc, is because we don't have any distractions from Swiss franc at the moment. So what you see here in the rallies is what you get from the British pound, and that basically shows that the British pound in fact has been getting stronger. It has broken above a key resistance level, or testing actually also as well. So we could in fact see more rallies coming up in the British pound across the major counterparts, especially if we do break above this level, and if we get more positive economic data out of the UK in the coming week. Let's actually go and check what we have on tap for the UK economy. Let me bring up my Bloomberg. Terminal to see what we have coming up. So yeah, today we did have a minor setback for the British pound, which does make sense why we saw the British pound drops, but hold on until Friday if you are thinking of trading the British pound, because at 10 a.m. GMT, which will be 10 a.m. Eastern time, that will be. So 10 a.m. Eastern time in New York, that would be 5 hours earlier on a GMT, so that would be I'm sorry, for a GMT on Friday, 10 a.m. Let me just convert this so that everybody can take a note. The conversions definitely does take time, right? So on a GMT, Friday's Bank of England statement will be at 3:15 p.m. That is when the Bank of England's Governor Carney speaks, and he's going to speak on a panel discussion at the 2015 conference in inclusive capitalism in London. And if he is more hawkish than expected, and if he does give us more hints about a potential interest rate hike in the UK, we could in fact expect a break above our current resistance level in the UK crosses and the British pound crosses, and see more rallies coming up. So that is it. We are running a little bit out of time with our coverage. So let's go ahead to our next country, the important one that I have been focusing on this week. That is Canada. What has been going on in Canada, and do we have any loony traders in the crowd? I'm actually not sure if I can see your chats over here. If you are typing, I apologize. for not answering. Okay, we do have some questions over here. Hold on 1 second. Let's see how we can reach the questions. Again, I apologize because it seems that I can't get the questions working. I certainly am trying my best to get the questions. I can see a lot of you have questions unanswered. For some reason, it is not showing on my screen at the moment. Hold on 1 second. No. Still can't see the questions. I apologize. Let's go ahead and cover Canada before we run out of time. So again, I'm going to cover Canada's inflation, trade activity, manufacturing, employment, and consumer spending, and then walk you through the Canadian dollar's chart to see what we can expect. Much has been said about Canada following the footsteps of the U.S. economy. So why is Canada really performing as well as the U.S.? First, let's start from inflation. Weak inflation no longer seems to be a concern in Canada's economy especially because the price levels are starting to recover from the spillover effects of the oil price slump. So crude oil prices have been gradually climbing since the start of the year, allowing the Canadian dollar to regain. So unlike the US dollar, Canadian dollar and oil prices have actually a positively correlated relationship. So the higher oil prices go, the higher Canadian dollar goes. This again, it comes down to how high can oil prices go. I have published an article on oil prices that we actually may not see further rallies in oil prices, which supports US dollar rallies, which in turn brings us to a Canadian dollar drop. But as far as Canada is concerned, right now they were kind of optimistic about oil prices, and that is the reason why we saw some rallies in Canadian dollar previously. So Canadian inflation figures for May surpassed expectations, though, regardless of what I think is going to happen to oil. They think the oil price is going to continue to rise, and their core CPI showed a 0.4% gain, higher than the projected 0.3%, and the headline CPI printed a 0.6% increase versus the 0.4% consequence. On an annualized basis, the core inflation is actually up 2.2% in May. For trade activity, the reason why I'm I would like to cover trade activity in Canada is that Canada is an export-dependent economy, and its trade figures have a huge say in overall economic growth. For the month of April, Canada's trade balance fell short of expectations, and it printed a $3 billion CAD deficit, and that was worse than the projected $2.1 billion shortfall in the Canadian dollar. And to make things worse, the previous month's reading was downgraded from an initially reported 3 billion Canadian dollar to a 3.9 billion Canadian dollar trade gap, and this has been the widest deficit in its history of deficits, basically, in Canada. The report components that are also important, if you dig into it a little bit, shows that the exports actually went down 0.7% in April, and this was if you look at the components on a monthly basis, this was the fourth consecutive monthly decline for exports. On a brighter note, the value of energy shipments actually picked up by 5.9% during the month, reflecting a rebound in the natural resources sector. However, non-energy exports fell by 2%. So again, this goes back to oil. Oil was up, but other than that, the non-energy exports fell by 2%, while the forest products exports were down 5%, signaling a downturn in external demand for other Canadian products. Of course, as long as we have China, who needs Canada, right? As far as manufacturing goes, manufacturing is hinting a potential rebound, and the indicators are subpar, while leading indicators suggest better days ahead. The manufacturing sales report for April marked a 2.1% slump, worse than the projected 1.3% decline. The previous month's report showed a negative revision from 2.9% to 2.7%. The IV PMI for May surprised the upside with its 62.3 reading, when analysts were expecting to see a drop from 58.2 to 55.1. Underlying figures show that the jump was basically caused by the significant gains in the employment, in inventory levels. I'm going to cover employment in a minute. And that indicates that businesses are ramping up to their production and operations once more. Canada's employment report for May reflected a strong hiring gains of 58.9 thousand, outpacing the 10.2 thousand increase. This was enough to keep the Canada's unemployment rate steady at 6.8% for May. And the labor force participation also picked up. Other underlying labor figures shows promising results. The private sector hiring and full-time employment accelerating. Wage growth was evident since average earnings of employees rose by 2.9% in May from a year ago, faster than the 2.4% annualized increase in April, while the numbers of hours worked climbed to 1.2%. Most industries such as manufacturing, healthcare, finance, and retail reported gains. Public administrations and agriculture sectors reported layoffs. In Alberta, Canada's oil industry yes, Alberta is a hub basically for Canada's oil industry. Next to Calgary, the number of jobs fell by 6.4 thousand, while the city's unemployment rate climbed from 5.5% to 5.8%. So kind of mixed signals on this end. Consumer spending, to cover that, employment gains and wage growth have yet to translate to stronger consumer spending. And both headline and core retail sales figures missed expectations and showed negative readings for April. Headline retail sales went down 0.1% instead of printing the predicted 0.7% increase, while core retail sales indicated a 0.6% decline versus the estimated 0.3% increase. There are some positive stuff, though. The results for March were upgraded to show a 0.9% increase in headline retail sales and a 0.7% gain in core consumer spending. But obviously you understand that these are lagging reports, which means that the economic improvements in May have yet to be reflected in the upcoming retail sales figure for the same months. All in all, we're getting a hopeful picture for the Canadian economy, but I mean it's better than Australia and New Zealand that I would like to cover if we have time today, but it's not that bad. I'd like to wrap up the Canada's economy overview with walking you through Canadian dollar chart. The dollar CAD pair. So bear in mind that the Canadian dollar and the dollar CAD pair is the base currency. So the stronger the dollar CAD pair gets, that means the Canadian dollar is actually going down and it's negative. So we've been seeing a rally in the US dollar as we have seen before, which means drops in the Canadian dollar, which is in tune with what I just covered about economic overviews of Canadian dollar. Let's take a look at another. Okay, let's take a look actually at Canadian dollar versus Japanese yen, where Canadian dollar is a quote currency, so we can get better understanding. As you can see, because of the mixed signals, the Canadian dollar has been consolidating. Japanese yen has been consolidating, so nothing is really moving. Over here, the rally was because of the Japanese yen strength. So that again, it cannot be an indication for Canada. We are continuing to get mixed signals from Canada, and unless something really positive or really negative happens, Canadian dollar can be a good fit for a cross currency of a currency that is a specific indication up or down, namely the US dollar. We are currently bullish on the US dollar, so the dollar CAD pair can be a good pick for trading because you can basically forget about Canada's economy and solely focus on the US economy and trade based on that. We are unfortunately running out of time. I did have more economy reviews prepared for you. Hopefully we will be able to cover them in our next webinar. Again, I apologize that I was not able to answer your questions. If you would like to get response to your questions, please do email Orbex.com, info@orbex.com, and they would hopefully forward your questions to me, and we can either cover them in our next webinars, or if you would like to sign up for a private session with myself, you can go to investdiva.com and have a one-on-one private lesson with me. We are having a campaigns from now and then, so definitely recommend that you sign up for a private webinar that we can actually chat and you can talk to me and tell me about your financial issues and your trading habits, and have a better outcome for the webinar. Again, thank you so much for attending, and hopefully I will see you in our next webinar. And as always, trade responsibly.